Can bank stocks sink the stock market? This has been a developing story, obviously, since March. You had the initial regional bank fallout in the middle of March. Interesting that we saw that stock volatility line up almost 3 years to the day of the pandemic outset in the middle of March. Obviously, that is all coincidence, but it looked like this regional bank story was a little bit over with, or at least healing. And in the last couple of days, regional banks have really turned over once again. They fought back from being down more than 30% in May. As the initial fallout in March, oh man, all these regional banks have a duration mismatch. They're going to really have some problems with their capital that's locked in at low interest rates for a long time, and their customers that want their money now, as money is harder to come by in a high interest rate environment. And that occurs in March. Losses continue until May, down over 30%, almost 40%, which, I mean, this is a diversified ETF of dozens of companies, almost cut in half. That's a huge move. Bounces back down less than 20% at one point in July, August range. The last couple of days turned over again, now again down more than 20% on the year, and in August off 7.5%. As you can see, we hone in on this recent action, and KRE, the regional bank stock ETF, has, like I said, really turned over in the last couple of weeks here as bank fear is resurging. Any coincidence around the fact that interest rates are rising? I think not, but there also is some stuff going on with ratings for some of these regional banks, and potentially ratings for some big financials that we'll get to here in a second. But I do want to first draw some correlations to see how likely it is that this bank story stays a bank story or becomes a stock market story. Because, I mean, you look at this chart of some of the major sectors, bank stocks down more than 20%, turning over in the last couple of days. And you've got a technology sector that's still up almost 40%. You've got industrials and energy still in positive territory. And obviously the S&P at large, which is majority tech stocks, up almost 20% on the year. When does this kind of bleed into the rest of those markets? Well, you highlight some of the big falls historically in bank stocks. And of course, the financial crisis and what that meant for bank stocks back in 2007, 2008, and 2009, of course, that bled over into the entire stock market. In the early days of the pandemic, that did obviously have a stock market wide effect there. And then even amid this story in March, you saw all these other sectors not performing positively in that range, but giving up not as much, but giving up a few percentage points along with that. And if you take another dip here, you would think that this will cross over, and you don't even have to think it. Let's take a look at some numbers here. Correlation between the Russell and bank stocks, 0.84. I mean, that's really, really high correlation. You don't really get into the 9 handle on correlation unless you're talking about like the S&P 100 compared to the S&P 500, or the S&P compared to Apple and Microsoft, which are, you know, individually almost 10% of that index. That's a real high correlation, which makes sense. Regional bank stocks are, it's right there in their name, regional. They're going to be smaller stocks in there, and the Russell is small cap. You go down to the Dow, though, and I was kind of surprised to see this. The Dow and the S&P around positive 0.5 correlation. Is that as high as, you know, 0.8, 0.9, what we were just talking about here with the Russell? No, but that's pretty darn significant. The piece, though, and again, this is why the resurgence of this regional bank story is maybe not hitting everybody's desk, is because the S&P 500, and then especially the NASDAQ, is majority tech stocks, and the correlation isn't quite there. When you look at NASDAQ, under 0.2, and you look at the tech sector in particular, 0.15. you're going to really need that correlation to increase, or like I say, the price action of bank stocks to bleed over into Apple, Microsoft, and some of those tech names for this story to really matter significantly to the general public. But here is the gateway, if you will, and this is why fear has been escalating this week. As we have the story out of Fitch ratings recently, an analyst went in and said, yeah, we're looking at potentially downgrading more of these regional banks. And I think the market was like, okay, well, that's bad for regional banks. But fear is building in financials in general, because they did name JP Morgan Chase up there at AA-, potentially falling down to A+. And we just had this story with the U.S. debt, and they went from, I think, AAA to AA+, and how much did that actually mean? It turned out not a lot. The U.S. dollar ended up green on that day, and everything else kind of shrugged it off. But why is this more important? Is Frank speaking out of both sides of his mouth? Maybe, but I don't think so, because this is more of a real sector-wide story. When you talk about downgrading, I think they named like 15 or so individual banks, and you include JP Morgan, which is right there at the top. I mean, in terms of financial sector, huge market cap, and really a big name that to see fall off of that top rung could have lasting effects in that sector. Now, again, and we conclude with this question of, is the stock market at large siloed off from this story? Well, if it remains a regional bank stock story, then yeah, you just saw the correlations under 0.2 for the NASDAQ and tech stocks rule the market right now. But you look at the correlation between NASDAQ and the financial sector, which isn't just those regional banks like PacWest and everything you've been hearing stories about, but those are your JP Morgans and some of those top line, Bank of America's, Morgan Stanley's, Goldman, and everybody else. They start to get affected by this, which I think was the fear back in March. You saw XLF dip significantly in March, April, and May, and you've got a correlation between financials and NASDAQ that's around positive 0.5, and historically has been as high as positive 0.8, positive 0.9. That's when I think you can really see this knock-on effect and see potentially bank stocks take down some of these financials with them and maybe create a little bit of a snowball effect for NASDAQ. What's that going to require? Probably going to require regional banks to move lower by another 10, 20% to get this NASDAQ to slip a few percentage points. But the story is there, from the bank ratings onto the bigger financial stocks, onto the big stocks in most people's portfolios and the major market indices.